Hello and welcome to Get Started in the Market. I'm Manvi Dhillon. Over the past few episodes, we've armed you with a basic startup kit for investing in the stock markets. You have a trader, who is a person who does the buying and selling of shares on your behalf, a trading account through which your transactions are routed, and a demat account which holds the shares you own in an electronic form. So let's step into the actual world of stock trading with an introduction on how to punch in your first trade. So let's step into the actual world of stock trading with an introduction to how to punch in your first trade. There are two different types of orders that you can punch in to buy or sell a stock: a market order or a limit order. So let's discuss each of them. A market order is when you put in a buy or a sell order and it gets executed immediately. That is, your order goes through immediately at the best available current price. You don't have to mention the price at which you're bidding. It's an instant go-through. The risk of using this option is that the price you last saw and decided to put in your order and the price at which the order actually goes through might vary. But if you want to buy a stock only at a specific predetermined price, you can use the option of a limit order. If you wanted to buy one share of Infosys at a predetermined price of 1,000 rupees, but the current market price of Infosys is 1,100 rupees, you can ask your broker to put in an order with a limit price of 1,000 rupees. So if and when the stock touches this price, your order will get executed. But what happens in case the stock does not touch the price that you have put in? In that case, you have the option of modifying your order. So you could revise the same order. In this case, you might choose to revise it upwards to 1,050 rupees in a bid to execute it. These orders are valid only for the same trading day. They do not get carried forward. You can use a similar order when you want to sell a stock by putting a stop loss. The idea of a stop loss is to reduce the amount of loss that you might have to incur. Let's take our previous example forward. In case you wanted to sell one Infosys stock which is trading at 1,100 rupees in the market, but you would only like to sell the stock when it has moved a little higher to 1,150 rupees, so you will put in 1,150 as the limit in your sell order. But what happens if the stock, instead of moving up, starts moving further down? Here you have the option of putting in a stop loss, which will limit your losses. So in this case, if you would have put a stop loss of 1,000 rupees, your trade would have gotten executed as soon as the stock would hit the lower limit of 1,000 rupees, saving you from any further losses. The choice of orders you punch in will depend on your investment profile. It is advisable for small retail investors like you and me to place limit orders and ensure that we have our stop losses in place. And beware of what we call the fat finger error. So be sure of what you've punched in before confirming your trade. So here are some basic thumb rules of trading. Do your homework on stocks you're betting on. Choose your broker carefully and understand brokerage charges. Always set aside the margin money in advance. Understand the T2T segment before trading online. Ensure that you have the stock in your demat account before punching in the sell order. Always verify your trades. NSE provides online and SMS alerts confirming your trade. Cross-check your contract notes, which will have all the details of the trade made in your name by the broker. And in case of any discrepancy, notify your broker immediately or approach NSE's investor cell within 15 days of the trade. Armed with all this practical knowledge on how to invest in the stock markets, after this break, we meet with veteran investor Ramesh Damani to get his advice on how to get started in the market with real investments.